Let's welcome our moderator, Mohammad Isbeer, Chief Institutional Officer at Equity Capital, who will lead a distinguished panel in the discussion on the invisible hand of liquidity, powering every trade. Please join me in a big round of applause.
Thank you everyone, and thank you for joining us for this panel. Just to be clear, I don't pick the names of these panels. I'm not that creative. The invisible hand of liquidity sounds really interesting. But we have an amazing set of panelists here. I'm gonna give the floor for each of them maybe for 30 seconds to introduce yourself before we start diving into specifics of this panel. We can start with you, Vincent. Do you have your... there's the next one.
Hey, hello everyone. I'm Vincent. I'm from CBSX Markets, and here is glad to be here today, sharing the sort of liquidity of gold market, especially for us in Hong Kong. And it's a expo of Asia, and as the only person from Asia, I hope I can express myself for more local gold liquidity aspects and share the insights with you guys. Thank you, everyone.
John Murillo, Chief Dealing Officer at B2Broker Group of Companies. We're a liquidity provider and tech provider in the space. Delighted to be back in Asia once again. So thank you for joining us.
Stavros from March Prime. We are a technology and liquidity provider. I hope you enjoy the panel. It will be interesting.
Hi guys, Dane from Camma Capital. I'm the Chief Commercial Officer. We're a CFD brokerage, and this is our first time in Hong Kong, so we're very excited.
Hi everyone, Alex. I'm the CEO of Finalto Asia. We're a liquidity provider to the institutional market, so really looking forward to this topic.
Paul, and as you can see, everyone, that we have the panelists that we have come from different backgrounds, from different regions in the world, which should give us a really good insights into the topics that we're discussing today. And as Vincent said, you know, we're going to focus on liquidity, but I think one of the most kind of pressing questions or liquidity questions that we hear today is gold. I mean, we see, I think, between all of us, we think, I don't want to be too extremist, but at least 50% of the flow that we're seeing, all of us, is concentrated in gold. So we want to discuss that a little bit in light of the recent changes of the central banks. You know, a lot of central bank shocks and a lot of structural changes into the liquidity of gold and FX. Not to mention, you know, the tariffs that, you know, Trump has coming in and out with. These are all obviously adding a lot of pressure on gold liquidity. And I think our job here to try to explain how that fragmentation that happens between liquidity providers and the banks, and how kind of the liquidity comes to the end client. I don't know if anybody wants to kind of start diving into this topic. Yes, Stavros, if you want to start.
Yes. First of all, you are not exaggerating with the 50%, I believe.
I was downplaying it. I was just trying to...
I was going to say, I mean, 80%, right?
I thought one of you was going to go, come on, man.
100.
It's a lot more, 50%, I believe. Also, we can see from our clients, of course, when liquidity is shifting to an instrument, we need to do something to assist the clients. The demand is growing a lot due to the political risks that you mentioned, and the environment now that is going with the sanctions and everything around now with the monetary policies and everything. This is pushing a lot the volatility and also some sudden movement of the gold. A lot of people are shifting clients. They are asking for it a lot. The clients keep asking for better conditions on there. So the liquidity providers need to adjust on supplying, let's say, what the client needs and satisfy their demands. So it's quite challenging the last couple of months, I would say, or more.
Yeah, I guess, I mean, just to continue on the same, there's so much demand on gold today. There's so much demand. If all of us were saying maybe 70, 80% of that demand is in gold, how we are filling this gap in liquidity? How are we being able to kind of accommodate? Dane, do you want to...
Yeah, I mean, going back to obviously what Stavros said, you know, we see a huge increase in gold demand from the client side. I mean, everything that we see that's happening in the market, I mean, we have Trump, right? Trump is a blessing for everyone, right? Every time he speaks, anything he does, kind of tariffs, anything that he gets involved with, we see that reflect in gold demand. I mean, it's evident that gold is now truly a safe haven. Everyone is investing, everyone is running to it. It's becoming the perfect hedge. Now, as you mentioned, client side, they want the best conditions, the best terms, and that's obviously our role as liquidity providers. How do we actually offer that to clients, especially when the volatility hits and you're looking at gaps, spikes, spreads widening? Cost of trading becomes very, very expensive, especially at a tier one liquidity level. And yeah, I suppose we're all in the same boat, just trying to manage and trying to offer the best conditions to our clients.
Yeah, I mean, are we talking maybe increased balance sheets? Are we talking more kind of new LPs coming into the space to kind of help that kind of meet that demand? What do you think, Alex? I mean, you're
Very key.
surprisingly quiet.
Really, right?
Look, I think balance sheet's obviously a big part of being a liquidity provider and the access to the underlying market. So at Finalto, we're fairly lucky. We have a wide range of customers, from refineries to jewelry shops to trading houses. So the liquidity for us, I think we've managed fairly well, just due to the diversification of our customer base. But, you know, balance sheet, they come to us for the balance sheet like they come to yourselves.
Yeah.
You know, but, you know, new entrants, it's very hard because they can't get the PB relationships.
John, anything to add?
So, yeah, I mean, just essentially we're all going through the same experience here. I always go back to the basics, and that is you need to be able to have that relationship with your partners and educate them on the current conditions that we're all going through. Liquidity, at the end of the day, in gold in particular right now, silver, we see a lot of business out of it. Spreads have gone wild. I mean, everybody has experienced perhaps one of the most unique periods in time, in recent time, where we're all going through what I see is a new shift in risk, an inflationary environment, and a geopolitical event that continues to take a toll on the most traded and active asset class in the whole industry. So I think you have to be able to communicate with your partner the reasoning behind some of these moves, because a lot of guys, despite the fact that they're running a business themselves in the broker-dealer space or whatever they're running, there seems to be a disconnection when these times come around. Now, some of us who've been in the industry for so many years, I've gone through SMBs and whatnots. We're kind of, to some degree, accustomed and we understand the dynamics of the market. But it is our duty as well to make sure our partners are capable to understand the underlying market. The conditions that we offer is basically we're leveraging balance sheets. But there's not enough credit lines out there, especially if you have a risk concentration element with your PE. A lot of this will always come down to how you pass that information to your partner. And I consider that a duty in each and one of us in this particular room.
Yeah. And I think that's exactly where I wanted to kind of get. I mean, it's that disconnect between the underlying clients and how much you're able to get from the PBs, whether from a capacity perspective or also from a liquidity provision perspective. And I think, John, we've had this conversation in the last 5 years. We've always been talking about gold, and then we mentioned also maybe the last 3 years that the withdrawal of Credit Suisse from the space has created more of a gap in terms of pricing gold properly. And that gap, in my opinion, with the increased demand, is just getting bigger and bigger, and I don't see anyone delving into that space to fill the gap. But, leveraging the balance sheet and all of that can be kind of the step, and maybe some of the prime of primes can step into that place and create that sort of liquidity. I don't know, Vincent, did you have anything to add on this?
The recent rate volatility and shocks has pushed the gold into both safe haven and speculative positioning. So from funding perspective, in our experience, because for our industry, most of the company, in my experience, having higher return on equity. So still compared to lots of other industries, like the return on equity is higher. So in this case, if you have institutional back and you have enough funding access, the funding part I wouldn't see so much of an issue. And some might think of a balance sheet, and that's very key considering the counterparty risk. At the same time, if you do have good access for funding, considering the return on equity is not hard for our industry raising the fund. But very importantly, like, do you have enough and the right hedging venues? For example, do you have gold future? Do you have ETF arbitragers for different type of flow? So like, especially now the e-trading part really dominating the liquidity side. So for smaller trade, you need better pricing, or for a larger trade, you want a best view. Maybe the price is not the best. So the last part, I would think, is the concentrated part. So if the client is really on the one direction, like last year, gold is really hiking. So in this case, how do you like make the concentration risk lower?
Yeah.
Are you able to hedge cross asset? Are you able to utilize your funding for the max capacity? I think these are the key for managing the gold liquidity in the recent years.
I couldn't agree more. Concentration risk is becoming a major issue and a major factor in the way we look at our books today. And which brings me to my next topic, and which is, I mean, I think something we discussed in the Dubai Expo last month, is how the markets have become more structural in volatility, which means, you know, with the introduction of AI and the introduction of automatic trading softwares and HFTs, now the reactions for market news, these AIs are just going to crawl and listen to the news even faster than we do, and the market is reacting in a faster and a stronger way than it used to be. Now we're all sitting on this highly concentrated risk books on gold. How do we as liquidity providers basically prepare for this?
Yeah, that's very true. Like, we do approach by lots of new systematic liquidity providers. So it's not like the standard one we normally know, like XTX. And the XTX part of technology is implementing by some other new market makers. So when they come to us, like, they can offer similar technology, but they want to understand your client's flow better. Because for XTX, they wouldn't get into your book. So they are your like a maker. Yeah. So how do you utilize this part of new technology is also a key part for our management.
Yeah. Anyone else? Yeah, on the.
Yeah. I think we had that big gold move last week, where we're down 5-6%, biggest move in 15 years. From our point of view, it was quite orderly. It wasn't big gaps. People were happy with fills. People were happy with for gradual decline. So I think the market actually can handle the volatility well.
Yes, I totally agree with this. Of course, it depends what risk model each company is running, because there are different risk models on the liquidity side, also on the broker side. If you are internalizing, for example, some of the flow, you need to be able to pay out to the client, especially if the exposure is directional. So there is one kind of risk there, whereas on the other side, if there will be very huge gaps and you are sending everything, for example, on the banks and everything, you need to be careful. Whereas we saw in the past with the CHF what happened, yes, with some very big, for example, shocks, which I believe this will be happening and happening all the time, especially now with the gold. We saw in one day that it plunges like 6%, for example. I believe this will happen again. But each company has its own internal risk management processes tailored to the models that we are running, and you need to be very careful. Yes, when especially on the directional side of the flow, you need to be very careful. Yeah. And this is something very important for us to understand, and also for the clients to understand when they trade, because clients are very demanding, and the conditions that they're asking are below market conditions, and we also need to, at the same time, safeguard the risk and satisfy the clients, yes, because they want, for example, like swap free or zero spread we see on the expo sometimes. This is nothing compared to real market conditions. So LPs and brokers need to educate the clients why and what are the conditions, and at the same time be able to market the product but be safe on the risk side. This is a key, to have a balance between the two. This is my...
Yeah. I mean, John, did you have anything to add on this?
Well, just to share, Alex, what you mentioned, it was an orderly, I would say, correction in the market. Did we see spreads going wider than usual? Of course. It was, to some degree, up to a certain point, a bit of a surprise, but not really at the same time. I think everyone was expecting some form of correction at any given point, especially on this uptrend. I think what comes down to tech is super important. There's a lot of vendors out there that today you can see they can step up to the game. You know, just probably 10, 15 years ago, you would not be able to find a lot of reliable partners on the tech side. Today, tech plays the key role. How fast you price, how quickly you can deploy different techs, and how adaptive your business can be to market conditions. Again, all of this is years of experience in each business, and how you best execute will come down to what relationship you have implemented over time.
Yeah. And I agree. I mean, tech is now in the heart, because we're seeing this systematic and structural changes in the way, you know, the market is reacting. We need to have the exact kind of amount of technology to be able to counterpart that in terms of pricing. But that also still kind of begs a bigger question for me. All of this concentration. I mean, the SMB happened when people had less than 5% of their books on Swiss franc. Yeah. Imagine an SMB event happen with people sitting on 70% of their books in gold. I mean, how do you answer that? I mean, I know it's a philosophical question, but I think it's something that we all need to think about, right?
On the next expo will be half the booths.
It might be. Dan, what do you say to that?
Yeah, I mean, look, there's not, yeah, as you said, it's a philosophical question, right? There isn't a right or wrong answer. But yeah, as you mentioned, we will, I think time will test the players, right? So, and another thing as well, these 6% moves that we saw last Friday, we're seeing the moves are so common now that we're seeing 2, 3, 4%, and that it's a scary environment for retail at the minute, because they see this so often now in the market, these big moves on gold, and it becomes the norm. This volatility that we're seeing somehow is now the market norm, and that's obviously something that, you know, brokers like us, that we have to consider, and especially when we're talking about liquidity and how we best kind of execute clients' flow. The internalization aspects, I mean, we joked about it being 90% balance sheet. You know, most of the flow, all of the flow that we're seeing is, you know, the risk is huge to a broker. So, I mean, yeah, I think there's not much else to really say on the matter in terms of what you can do. You just have to hope that your internal structure, everything that you have in place, is rigid enough to kind of survive these big kind of waves going forward.
Yeah. You want to add something, Vincent?
Yeah, I think that's very true that every one of us still having a booth in the expo, so we shouldn't have much of counterparty risk. So I think so when lots of shock and spikes happens, counterparty risk is very key, and that's the top thing for fund security. So when you are selecting your liquidity source, do you really check who they are backed? And when the spike happens, are they maintaining the stable spread, or they can't even trade, they reject the order? So are you still able to hedge? That's very key. Like, it's not only about pricing, but how stable when shocks happens. Because now we don't see when calm period, liquidity is similar, but it's always spike and shocks compared to pre-2019, before COVID. We don't see so much spike happens in 1 year. So how do you manage the rate? Do you have enough hedging values? And how do you manage your counterparty risk is very key.
Yeah. I think, Alex, do you want to say something?
Well, you know, we're talking about balance sheets, etc., as well, about counterparty risk. One of the big things is also regulation. we're all highly regulated firms, but you've got to look at your counterpart, where they're regulated, how they're regulated, and how long they've been around. It makes a big difference.
Yeah, and I agree. Maybe these are the three kind of aspects that we look at: technology, balance sheet, and regulation. And I think within balance sheet, we talk about, my next topic is like prime brokerage, right? So prime brokerage also relies on your balance sheet. How much the prime brokers can step into the space and offer kind of that sort of lines and liquidity to be able to absorb the increasing demand and flow, but that also requires much higher balance sheets from brokers. So we covered technology, and I think we all agree, having the right circuit breakers in place, having the right fast technologies to kind of accommodate. Regulation is the next thing. Let's talk about regulation. How are these regulation now protecting clients from these events? How do you see the changes in the regulation affecting liquidity and affecting and protecting clients more into this space? Stavros, yeah?
Of course, regulation was always important and will be always very important, yes, because if you are highly regulated, it means that you report some of the very specific things that you need to, and clients need to be very careful, not going and sign up with one broker that in 1 year will be disappearing, for example. They need to be checking which brokers are there for a lot of years and have their reputation and everything. It's very important to be highly regulated. The reputation is very important. Reviews are everywhere. You can easily hear around what are the problems. With unregulated firms, which a lot of times they disappearing, especially in such markets that they are very dynamic and directional, let's say. This will keep happening. It was always happening. Regulation is very, very important and will be very important, yes.
Jane, did you want to?
Yeah, I was just leading on from what you're saying. Of course, it's one of the most important factors. But obviously, the time that you've been around is obviously very relevant. But even for new entrants into the market, if they get the right regulation, it gives them that credibility from the offset. So they don't have to build up kind of no longevity in the market. They don't need to say we've been around for 10 years. They can just enter the market with the right foundation to say that we're fully regulated in these regions, and these are the protections that we're willing to pay for to give back to the clients. And I suppose that's practically what regulation means, right? It's offering their protections back to the client.
Yeah, but don't you think that sometimes we're over-regulating? I mean, can regulation also have a negative effect into these proceedings? And
Yes.
Yeah.
But, regulation is good. It means legitimate businesses stay around and provide a good product.
Yeah.
So, regulation is good. It helps us all out. And, the business is not getting smaller.
So you need more stability. You need more.
Well, that means it's a stable market, right?
Yeah.
So, the flow that everybody's seeing, it's increasing.
Yeah.
Products are getting bigger. More products are being launched by us leverage brokers. So, regulation is good.
I agree with you on that front. I mean, there's two sides of a coin. If you're over-regulated, then you can't really scale your business. On the other side, if you're lightly regulated, it's not necessarily the most credible environment you want to be in. So I think choosing your regulatory framework from the jurisdictional standpoint is truly what gives value to our partners, being our customers. I think if you find that balance, if you find those jurisdictions which serves both stability and fairness to the customer, you're poised for a very strong growth appeal within the industry.
Yeah. Did you want to add anything, Vincent, on this?
Yeah, I think the reason why in our industry we are always talking about a balance sheet, prime broker, because our industry, I think, is still very not capitalized industry. And it's mostly private-owned company. And but if you are backed by some larger financial institution, like, for example, we have a partner, they have thousands of gold shops. And so their rate for loaning gold is 1%. So if we are able to input that part of liquidity and can get in volume in and with access to institutional fund and being capitalized to set up a more closer relationships with the financial institution. I think funding gap gonna be filled, considering the return on equity again for our industry is still higher than most of the industries. So I think we should should capitalize the company for more and to be able to get wider part of liquidity.
Yeah, I mean, okay, great. I think we're covering a lot of ground here, and I think that natural is we talked about regulation and how important regulation is, and like you said, John, you need as a company or as a group of companies, you need to structure yourself in a way where you can allow flexibility, but at the same time safety to clients. But that's good on our level when you're a prime of prime. But when it comes to the underlying retail clients and choosing their own retail broker to trade with, is the question regulation or is it balance sheet? I mean, is balance sheet more important than regulation? Because we know how the game goes. You have a great regulation somewhere, but all of your retail clients are going offshore. So which one is more important now? Is it regulation? Is it liquidity? Is it prime brokerage? Or is it just a balance sheet? And that's an important question, and it trickles down up the ladder until whether do you have, as a prime of prime, do you work with a prime brokerage or do you kind of recycle your liquidity from somewhere else? And for me, that whole chain is what creates the fragmentation between the retail or the underlying client who wants to trade in 50 lots on gold, while the underlying liquidity doesn't allow more than 5 at top of book, And then how do you kind of correct all this chain and create that ripple effect that everybody... John, I think you and me, we spoke about this in length in the last 5 years. I just don't know what's the solution at this point.
Well, you're asking for a miracle. At the end of the day, it's just, again, education, sharing with your partner what that order book stands for, how an order is actually executed and why. Sadly, the retail type of customer has a tendency to believe that you can execute, 500 lots in one clip, and there's no market impact because all they see on their terminals usually is just top of the book, and that's where the brokers, primarily broker dealers, get themselves in a little bit of trouble because the customer says, wait a minute, I sold gold at this price and you executed me, your slippage is out of this world. But hold up a second, if the order actually hit the street, it was based on that order book that we facilitated as an LP. There's a disconnection on this front, and I've seen it all throughout my career. And to these days, no matter where you're dealing with, in which jurisdiction, what is your geographical concentration of business, everyone has this difficulty of understanding how the underlying market actually operates. Yeah. Gold is ultimately, is an OTC product, rolling spot product, but people try to, or somehow imagine that the retail guy, that what they see is what they get. And there's no such thing, at least not in our line of business.
Unfortunately, Dan, please, but what I want to say before you start, unfortunately, even a lot of the primes, they also do that. They allow their broker clients to execute on a much higher top of book prices than what the underlying liquidity is. So
I was just going to follow on from what John said. I think maybe another fundamental should be an education aspect. We talked about balance sheet, regulation, tech, etc. I think maybe there should be some form of education that's necessary in our industry, because I think a lot of the misconceptions and a lot of the issues that we have to deal with on a day-to-day as a brokerage probably come from some form of miscommunication from the client expectation. They don't really understand what they're doing, so they expect something, and then other traders, they all combine in these threads, and they all say, yep, I can do this broker, I can get this leverage, I can get this execution, I can get this spread, and then obviously it's shared around the market and then creates an unhealthy expectation. And obviously if you don't offer that, then you obviously lose a client and they go somewhere else that will give them them terms. So
follow you on LinkedIn and learn a lot about liquidity.
If they're following me on LinkedIn, they will know the gold, right? For sure.
Anything from you, Alex, on this?
It's basically a liquidity mirage, right? we're out there providing, if we're all sitting here, we're providing $100 million worth of gold now across our books. The market doesn't have that. So we created a liquidity mirage, but that's for business.
Yeah.
And it's how your diversification of customers, how you handle it, your technology. But, if you make the price, you've got some need for it.
Yeah. Which takes me naturally to a topic that you brought up, Stavros, before the panel, which is, a lot of the mirage or a lot of the kind of the deals that are being put out by the so-called liquidity providers that kind of luring clients in to be true. A lot of risk offering in the market out there. How do we, as serious prime of primes, how do you fight against this? What are the things that are too good to be true? How do we explain this? I mean, I don't know if in our audience maybe there's a lot of brokers, startup brokers. How do you fight against this? How do you, Bo, did you have...
Yeah. So I think first of all, to enhance more of your technology. So having better and involve better market maker because retail flow is retail flow, and there is huge gap between retail and prime of prime. So education is the key. With lots of new brokers in everywhere, so it's very difficult for them understanding prime of prime or the underlyings. So how do you compete with the markets? So I think technology is very key. And how do you profile your different clients? How do you profile your flow? And also, everyone might face the very sharp flow from China, from Asia. That how do you manage? How do you pick them as possible, and then put them into the right pool? At the same time, for retail, it's softer flows. How do you, by your technology, how do you offer them a better liquidity for their profile? So again, I think client profiling is a key, and the technology, the market making skill is another key. So and education is also a key. For them, how to know that? Yeah.
Yeah. Anyone on the, how do you compete with these? I don't want to say compete because I think that's the wrong word. But how you overcome these challenges of, crazy offering from, prime of primes, and how do you fight against it?
It's basically education is the most important, I believe. Technology, education, the risks are different. You need to explain the risks to the guys that keep asking for such things. For example, if you are asking for a zero spread and something that is a non-market, then you want to withdraw 5 million, you need to take your money back. So there should be some balance. You cannot ask for everything that doesn't exist in the market, and then we need to be able to pay everyone. So we need to give conditions that are market conditions and not off-market conditions. There is some risk. If you see some watch selling for $100 and it's a Rolex, something is wrong. Yeah. You cannot buy it. So you need to be careful. There is different risks on this retail side, on the clients, and on the liquidity side, both on managing the risk and the trustworthiness.
So we're saying education is becoming like an essence of on the retail side, on the broker side, because it seems like people are falling for this over and over again. Every time we say something like a new company goes bust, and then we say, okay, everyone learned now, but apparently, this keeps happening, and the same people, they just go again. Did you have anything to say, Dane?
I mean, yeah, I'll re-say what I said a little bit earlier, right? That the education, I don't think anything is going to change until education comes through. Till retail are actually aware of how the market works, the actual technicalities of offering a product or a synthetic product at that, and then the demands around what they expect that certain product to be. I mean, most of the demands that we see are just unachievable by anyone. But there are, as you said, there's brokers out there that are willing to offer these insane leverages. Swap-free. I mean, it seems to be everywhere, and I don't really understand how brokers are surviving when they're offering, a client that's just sitting long on gold for 6 months, and how they're managing, netting that off somehow to make money is beyond me. But
Sorry. And also because the competition is increasing a lot, these things will keep going and going. The competition is increasing a lot, the conditions are tightening, the spreads and everything. So brokers want to compete, the costs are high. So they are pushing themselves at a level that is quite difficult to handle. And this is something that we need to, as I said before, manage the risk effectively and at the same time be competitive.
I think
I'd just like to add on what everyone said on this topic. Remember many panels over the years, the race to the bottom. Look, guys, there's a race, and everyone would love to be as competitive as possible. But there's a reality behind is that if it sounds too good to be true, it's not real. Let's begin with the most basic concept in life. Secondly, you got to manage expectations. If you can't do this, if you can't train your own team to talk to your clients will never understand the reality behind. So it is also our duty, and I find us all here in particular, we have a responsibility with our clients is that we have to be very clear what they can expect and what they should not expect. Once you set the clear rules of engagement, there's no misunderstandings. This is what you're doing. This is what you got yourself involved. And that's what I think a lot of participants are lacking is a strong approach towards realism. This is my view on this particular subject.
I couldn't agree more. And I've always, I've always kind of said to my guys, if somebody asks for a lot, just let them go. Try to educate them, like convince them not to go with this kind of offering, because eventually they're going to come back, but they're not going to come back unscathed. They're going to come back with a proper dent. But at the end of the day, you have to let them go, and eventually they will all come back, because that's not realistic. That's what happens. All right, I think, did you want to add anything on this, Vincent, or should we?
Yeah, last bit is we can't offer where we can't to the wrong client, wrong pool to the wrong clients, but we should really do a match. So for what type of client, we can offer what type of pool. And that's very crucial. And keep your bottom line always, and control the risk. I think that's the very key part. Like just not to offer any type just to win the flow. I think it's totally wrong. Yeah.
Well, we only have 3 minutes left, so I have one question that I can do, but I want to give an opportunity if there's anyone wants to ask a question for our panelists. Yeah? Got one?
Yeah, I've got a question. Given that gold has quadrupled in value over the last couple of years, which effectively means a division of the dollars per million in the gold sense, how have the other brokers been handling that?
Anyone wants to take this?
Well, I think we all charge commissions per dollar, right? So it hasn't affected us too much there, but the spreads obviously pippage points when you're trading. It's spreads have basically come in 30% from what they were 2 years ago.
It's true, but maybe with increased volume, a smaller margin but higher volume. Anyone else would like to? All right. Any other questions from the crowd? Tom?
Hello there. Thanks for the panel. Interesting. Is liquidity in Asia different from liquidity in Europe? And if so, how?
That's a great question. Anyone?
I'd say it's a bit different, yes. In Asia, liquidity, you mean on the gold side or generally? Generally. No, I would say not very, very different. No. I wouldn't say it's very different, the liquidity on Asia.
Alex?
Obviously, the volume is lower in Asia, but with most of the pricing is still being developed out of London. So that's the main data center. Asia is picking up. Tokyo is obviously very big. Singapore is building, but it is different liquidity. But it mainly still comes from London.
Vincent, maybe you have a view on this. I mean, you worked both sides of the world.
I think it's different for sure, because for Asia, there is a Shanghai Gold Exchange. That's where most of the physical gold providers hedge their risk. And in London, they call it London Gold. And the price is even different. And also the consumer, for the clients, what they are expecting is also different. And in Hong Kong, I know, like many of you might heard, they place 50, 100 lot with no slippage, and the market makers of Hong Kong who gonna take it. And we have like Shenzhen, the gold market, and they expect the offer much better than the standard primary prime who can offer. So how do we deal with it? It's also a very good question. And what's our bottom line? What can we offer? And what's our difference? So I do think that different liquidity and also different clients' expectation, the both.
Right, I think we ran out of time. I would love to take another question, but I think we're done for the day. But I would like to thank all my fellow panelists. Really appreciate you taking the time. And I thank you all for attending. It was a very interesting panel. And I thank the IFX Expo guys, always giving us this platform to speak on. Thank you so much, everyone.